You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYFI.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how are you doing?
I'm doing great, thanks. As you can see, still in my home office, even though I was out last week and also have a couple of days out the next few days.
There's no place like home.
Exactly.
Glad to have you. And we also have a guest for our listeners today. So we have Mark Hendricks. Mark, do you want to do a quick intro of yourself?
Yeah, thanks so much for having me on. My name's Mark. We run a hedge fund out of London. We look at all sectors, so not only shipping. We've been running this fund for close to 17 years. Myself and my two co-founders spun out of an investment bank. Prior to that, we were running a similar strategy, looking across sectors across the world.
Amazing. Well, we're really excited to have you on. I'm sure your expertise will be really interesting for a lot of our listeners here. Let's go ahead and get started with rates. Lars, where are we at with rates right now?
We are at, let's say, a point where everything remains quite unsettled, but that's what we've sort of also been alluding to last few weeks. If we look over on the quoted markets, it's basically staying in place on the SCFI, both for Asia, Europe, and on the Trans-Pacific, a little bit up, a little bit down, nothing exciting, so to speak. The main major development last week was actually rather down to East Coast South America, where the SCFI benchmark from Shanghai to Santos was up more than $400 per TEU in just a single week. That, of course, sounds significant, but for context, the Shanghai to East Coast South America market had declined much more than that in recent weeks. So it's trying to catch up to the losses over the past month or so, not quite making it though. So on the quoted market, the market is kind of jittery and not really moving in any main direction. If we go over to the NYFI rates and look at what are spot rates for actual loaded cargo, in the aggregate, Pacific Index is down. If we look at the overall Pacific Index from Asia to US West Coast, as well as from Asia to US East Coast, it is down week on week. But, and again, for this unsettled market, there are major differences when we look at subtrades and look at equipment. Let's take a few examples. If we're looking going into the US West Coast for 40-foot containers, if you're coming from Southeast Asia, it was a 13% drop compared to a week before. Substantial decline from Southeast Asia. Whereas if you came from Northeast Asia, you were up marginally by 0.3%. So huge difference here depending on whether you were shipping out of Vietnam or whether you were shipping out of Korea. This is a market then where the 20-footers at least were more stable, although negative, because 20-footers were down 10% on all the subtrades into West Coast. But the West Coast, again, very different from the US East Coast. So if you look at Asia into the US East Coast, we see China being the most stable, but still down by 4% on 40-footers. Whereas if you come from Southeast Asia, which would say, for example, Vietnam, Thailand, Singapore, Cambodia, you're down 8%, so twice the decline as we see from China. On the 20-footers, different story again. For the 20-footers, China is the most negatively impacted, with 20-footers down 9%, but 20-footers from Northeast Asia, so that will again be Korea and Japan, is actually marginally up. So we continue to see this pattern we've now seen for several weeks, where the overall direction is negative. Then we have shorter periods with rate increases, usually much less than indicated by the quoted rates on the SCFI. But when you dig into subtrades, there's a huge element of volatility swinging almost week to week as carriers seem to reallocate capacity. And for shippers, this is a very, very tricky situation to navigate.
Yeah, it sounds like it. Mark, I'd love to hear from you. So you work with shipping equities, and maybe for the layperson, you should probably just briefly explain what that means. But can you explain how freight rates influence the value of these stocks and what kind of risks investors like you face?
Yes, absolutely. Great question. So when we value companies, we usually look at the future cash flows of that company, and we'll discount those to current to determine whether there's an opportunity to invest in the equity or not. So specifically in shipping, obviously that means we need to have an estimate of the cash flows of shipping companies, and with that, the freight prices really matter. We need to try and estimate future freight prices to build our models so that we can come up with those cash flow estimates. And as Lars mentioned, given the volatility that we see in freight rates, it makes it really tricky. The amount of moves have been significant. Obviously, we went through the COVID period, which is really volatile. But even now, the volatility makes it really tricky to get confidence in that forecast. And I'm sure, as we're seeing with many of the shipping companies, even the management teams, they also struggle with those freight rates and kind of where they may go.
Maybe a question here on my part, because this podcast is about container shipping. That's what we usually do. But I can't help but think, when you say shipping equities, of course, there are a lot of shipping companies out there that are not container shipping lines. And it seems to me, when I look at the data, that the extreme volatility in container shipping freight rates is mainly something that has emerged over the last 5 years. Prior to that, it was a lot more stable. Whereas if we look at tankers and bulkers, suddenly having freight rates increase by a factor of 10 for a period has been par for the course for the better part of a century. Does that mean that you simply have to readjust equity models for container lines to be more like what you do for tankers and bulkers?
Well, what we certainly see is that the valuations that the market ascribes to the shipping companies are quite low, and that's due to the uncertainty. So when we see sectors that are more volatile, the market is concerned and won't pay up for that. And that effectively is a higher cost of capital. We see that across the shipping industry. Obviously, certain different shipping models, you have different abilities to hedge. There's different futures markets, but some of those are more bilateral. So, for instance, in the bulk you mentioned, those are forwards, and they are OTC contracts typically, and those they're quite different because they are very specific, very tailored, which we as equity investors won't have visibility on. Where there are futures, and unfortunately in the shipping there's not that many, but where there are futures in, say, in other commodities, they're much more transparent, and that transparency allows for us to effectively have better predictions of where earnings may be. And with that, you can effectively pay up because you have more confidence in a company's earnings ability. So I think what's important is that the transparency that potential shipping futures could bring would certainly help equity investors get higher confidence in their forecasting ability.
Okay, thanks.
Yeah, that makes a lot of sense. Awesome. Let's move on to our next topic. So the trade war and tariffs. Lars, what's the latest there?
I have good news because I have no news. I think for the first time I was almost about to say in the entire history of our podcast, there is nothing new in terms of tariffs coming out from the US. I take that as an absolute win for all trade participants this week.
Yes, we'll take our wins where we can. I would agree there. Awesome. All right. Quick segment. So let's talk now about global reliability. Do we have any new numbers there?
Yeah, the monthly reliability report from Sea Intelligence came out here during the past week. And if you look at the overall global average, that was a bit of a decline. We went down to 61% global average schedule reliability. That was down from 65 the month prior. That also means that, keep in mind, when the alliances put in all their new services early in the year, we saw a substantial increase in reliability. Then we reached a plateau around the 65% level, which was still lower than pre-pandemic norm. But now we saw another decline. But I want to add another twist to this one, because sometimes we should not stare ourselves blind on the overall average number. What I find really interesting when you dig into the underlying numbers is the difference in performance across not just carriers, but also across the alliance products. Because what we have seen here is, even though everybody has indeed improved, some have improved substantially more than others. So the difference you get in performance, depending on which carrier or which alliance, is now much larger than what we've seen, not just during this extremely disruptive period, but it's actually also larger than the difference you got in the period from 2017 to 2019, when the old alliances were stable and in place. So in terms of product differentiation, there is actually a positive story here.
Okay, that's good to hear. Mark, from your perspective, reliability issues in general for anyone in the supply chain just adds another layer of uncertainty. But from your perspective, how do banks or investors view operational unpredictability?
Yeah, also a great question. So investors like stability and predictability. So anything that brings in uncertainty, effectively, we need to increase the risk premium that we're willing to take on that. So where there are cases where you can lower that volatility and that uncertainty, we'll pay more for that. What we see in terms of from a hedging perspective is that in certain industries and certain capital intensive industries, they do make use of hedges, and that can help actually lower financing costs. So in certain project builds, and I'm thinking of the mining sector here as a comparison, often bank financing to fund a new project comes along with hedging a portion of that production out of a few years. And with that, those companies are able to get lower debt costs. So thinking to the shipping industry, if there was a liquid futures market where hedging could take place, you could find that certain shipping companies could obtain lower debt financing on potential ship builds going out if they're able to hedge a portion of the freight rate for a few years. It certainly helps. Investors typically prefer to be able to more reliably forecast earnings. And with that unpredictability is always quite tricky for us.
Yeah, that's super clear understanding. Thank you for walking us through that. All right. So now we're going to talk a little bit about the ONE Henry Hudson. So we spoke about that recently. Lars, are there any updates that we want to share with the listeners?
Yeah, you can say the fire on ONE Hudson, we still don't have the details on why it broke out, but at least the fire was now managed, brought under control. The vessel has been pulled back to berth. But we have also seen how the owners of the ONE Henry Hudson have now declared general average. So that means anybody with cargo on board that ship, whether that cargo is damaged or not, will have to talk to the general average adjusters and put up financial security in order to get their cargo back. And I want to use this simply as also an opportunity to remind all the shippers out there that this is also why usually most choose to have insurance. It's not just about the loss if your cargo gets damaged. It's also the financial liability in precisely these cases where if you have insurance, fine, that's between the general average adjuster and your insurance company and you can get your cargo released. If not, then you got to go to the general average adjuster and put financial securities for your part of the cost of salvage on the ONE Henry Hudson before you can even get your cargo.
And can you explain how they come to the price of what each shipper has to pay for general average?
Yeah, and to make it very simplified, perhaps a little bit too simplified, you take a look at what was the cost of the salvage operation here and what is the value of the ship and the goods on board the ship. And then you simply pay, I was about to say your fair share. I'm not sure shippers would use the word fair when we're talking general average, but that is what it is. So let's say the overall value of ship and cargo is, just to put a completely random number out, let's say it's $100 million and you have containers with cargo which has a value of $1 million on board. That's 1%. So you pay 1% of the salvage cost as well, no matter what the salvage cost is.
A little brutal, depending on how much that ends up being, but a good thing to touch on and be aware of.
My usual go-to comparison is kind of you're taking a bus ride, then the bus goes into a ditch and has to be picked up by a tow truck. Now you as a passenger have to pay your share of the tow truck, but that's how shipping works.
Yeah, I would agree with what you said about your fair share. Maybe it's not quite so fair. But all right, good to know and for our listeners to be aware of, especially if you might be affected by that. So there's been a lot of hype around the Red Sea, a lot of excitement brewing. Are there any material updates? What's kind of the latest here that we should talk through?
Yeah, I think that the latest is, first of all, hype is the right word. I mean, the Suez Canal was out saying Maersk would return in December, which Maersk was then out debunking within less than a few hours. It's very clear that the Suez Canal authorities are extremely eager to hype up or put pressure on everybody to go back. That's not new. That's what they've been doing the last year. I have also seen there's been press reports saying that Maersk will revert shortly or Zim will revert shortly. And when you read what these liner shipping companies are saying, their position is basically unchanged. They're saying the same thing they've said for 2 years. We will return as rapidly as possible when it is safe. That's unchanged. And I think they genuinely mean it. You can then argue the one thing that potentially is slowly shifting is it does appear there might be light at the end of the tunnel. It does appear we have more of a stabilized situation. So we could conceivably see a shift coming back to the Suez. The only major carrier where we see some development is with the CMA CGM. As I think we've spoken about before, for the last year, they've had 2 services that they were running through the area, so nothing new there. But they have slowly ramped that one up. So on their FAL 1 and FAL 3 Asia North Europe services, they have some of their sailings now lined up on the backhaul, not the head haul, but on the backhaul. to go back through here from late December. You also have some sailings on the Indomex service between Indian subcontinent, US East Coast. So they're slowly ramping up the number of sailings that they're putting through. But again, that's CMA CGM. They've been doing it for quite a while. There is no tangible evidence that any of the other ones are shifting just yet.
Okay. So what might this mean for freight rates going into next year with your infallible crystal ball?
My infallible crystal ball, okay, this freight rates next year, that's going to be easy. They're going to be crazy down and crazy up, all at the same time. All jokes aside, keep in mind how freight rates have behaved this year. We have had multiple spikes and troughs. We have seen multiple times how freight rates suddenly went up $2,000, $3,000, $5,000 in a matter of weeks, only to stay at that spike for a relatively short period of time, then come back down, then another spike, then another spike. We should expect more of the same next year. Two reasons. One being the Red Sea. There is a genuine likelihood that we might see a reversal back to a Red Sea routing. When that happens, as we've talked about many times, that will result in massive port congestion in Europe. That will mean all services in and out of Europe will be compromised. So it's also the Atlantic, it's Europe to South America, it's Europe to Africa. There's going to be a much smaller element of the same also hitting the US East Coast. So US East Coast to South America will be impaired. And this will not be a linear, simple process. So there will be peaks and troughs during that one. Technicality here is you might see freight rates decline at some points, but at the same time might see port congestion surcharges on the importing side in Europe skyrocket. So your end-to-end pricing might actually still go up no matter what the freight rates are saying. So that's one of the disruptive factors that could cause a lot of reverberations back and forth next year. The other one is a different element. Imports into North America, into Europe, is sharply down in recent months. We talked last week about how some of the individual commodities like toys were down 30-odd%, furniture down the same. So it would seem to imply there is an element of inventory reduction going on in the US, which also tees the ball up that at some point in time, again, unpredictable when, but at some point in time, there'll be an inventory replenishment. And we know from past history, inventory replenishments tend to happen fairly rapidly. When they do, you can easily see 10-20% increase in demand for a short and temporary period, again setting the stage for more extremely volatile swings in freight rates. So what will the freight rate be next year? Well, it will be crazy up and crazy down multiple times in both directions, which is, of course, not a very happy circumstance if you're looking for stability in your supply chain management.
Yeah, I would agree with that. And Mark, maybe you could talk a little bit about this. So while you don't ship cargo directly, freight volatility still matters to you and it affects the companies that you invest in. So how do investors use futures, as an example, to protect themselves even when there's no physical exposure to the freight?
Sure. So, I mean, the futures market, they all differ by their underlying. So they're not uniform in terms of the way that they behave. And typically, futures markets are slightly more volatile than the spot markets, which is quite scary when we think about the spot markets that we're talking about. But there's a reason for that. And that's usually it's the participants in futures markets. So in your futures markets, you usually have your direct participants, and that in this case would be the shipping companies and the consumers and the traders. But then in addition to that, you would have financial investors that will trade in that futures market, and they usually use leverage. So whenever we have that leverage added, that can add that additional volatility. Now, what's also interesting is that in certain markets where futures were introduced, the spot market volatility reduced. So that's happened in quite a few cases, like when oil futures were introduced in the 70s, you had a reduction in some of the spot market volatility, but the futures market remains slightly volatile versus the spot. So, there are a lot of moving parts in that. And also the key is liquidity. So what you definitely want in a futures market is a liquid contract that is actually a reasonable reflection of the underlying reality. If it is less liquid, the moves are typically sharper, they're bigger. And so you need to be careful. And once again, you can't really use a uniform analysis across all futures markets. Now, from a reducing volatility standpoint, there are a few things. Obviously, there are a few things that companies can do, so they themselves can use those futures to hedge, as well as investors like ourselves, where we're analyzing equities. We can also use those, but it does bring in further complications such as hedging ratios. That's one of the key questions that we ask ourselves: is that if we were to buy a company and hedge by selling the underlying future. So, for example, we could buy a shipping company, the equity, and if we think that the equity was mispriced relative to the futures price of, say, the freight rate, we could sell a portion of those freight rates. But obviously, you need to be very careful here because you do have that volatile freight rate future. There is the hedging ratio, which we say, so how much do you hedge versus what the equity is implying? So there's a lot of art versus science in here, but it certainly is a tool that can be used where investors can try and lock in an arbitrage, where we think there is this mispricing of equities versus the underlying product that they make or sell or sale. So that's one of the big things that we look at our hedge fund. What's also important, though, is what can companies do to manage their volatility. And this is kind of linked to that. So even if we're not doing it ourselves, the companies, if there is a liquid futures market, they can lock in prices where they may feel they're too high or too low. They can obviously sell or buy those futures. And we've seen that across other commodity markets. If I reference the mining sector again, we see quite frequently that some companies will sell a portion of their production and they can sell them out a few years. So if you've got some duration, so, a year, 2 years, 3 years out, they can sell a portion of their production and lock in a price so that their cash flows are more predictable, more stable. And that can be used in instances. We've seen companies that are in the process of doing some large acquisitions. We've seen quite recently one of the largest gold mining companies in the world entered into a 3-year gold hedge because they were about to do a large acquisition, which would have levered up the balance sheet. So there's tools like that where they can mitigate risk. So that gives equity investors some comfort that, that they're not pushing the balance sheet too far. In other instances, they may just be hedging because they think the price, they often have better information than non-participants, and they think a price is wrong and they can lock in those arbitrages themselves. So there are a number of ways that either us as investors or as the actual operators can use the futures effectively.
Yeah, now I might want to add, if I'm seeing this from the shipper perspective, when I'm looking at a daunting, volatile year like 2026, you have to keep in mind for many shippers, it's not a one-dimensional affair. Do I get the best freight rate or not? It's also a matter of, do I actually get space on the vessels? And if we look over the past 5 years, of course, it's clear when the market suddenly goes downhill and there's overcapacity, you have no problem getting space, usually. But we have also seen on the, let me call it, festive events where suddenly freight rates are skyrocketing. The problem is not just the freight rate, but can you actually even get your cargo moved? And as supply chain manager, you're suddenly caught between a rock and a hard place because you have to fight a war on two fronts. One is trying to limit your exposure to rapidly increasing, not just freight rates, but surcharges, but also fight to even physically get your cargo moved, where at least the derivative products that are coming out through NYSEX starting Q1 next year allows to separate those two discussions. So the supply chain manager is focused on the physical supply chain, whereas the financial risk management of this basically moves over to typically the CFO and the finance division in the companies.
Absolutely. And, if we look at the brokerage investment banks that cover the shipping sectors, they're forecasting on average a 16% drop in freight rates for 2026 versus 2025. Now, as you've mentioned, who knows what they're going to be? We know they're going to be volatile, but and they're going to be throughout the year incredibly volatile, given Red Sea, given potential oversupply with new ships coming online, but given some offsets too. If you're the CFO and you can potentially lock in a portion of your revenues because you think things are maybe better or worse, that once again, you can manage your business a lot better. You can manage that instability and that volatility and reduce it. And so a really useful tool for the CFO.
Yeah, really interesting stuff. Thank you so much for sharing that. Before we wrap up today's episode, is there any final thoughts, anything you want to share?
No, I think I just want to add a comment. I mean, Mark, you were mentioning your expectation is a 16% decline in freight rates next year. I must admit, I'm coming from the opposite perspective. If we see an opening of the Red Sea, if we also see that inventory correction happening over in the US, I can easily see a 2026 where rates on average end up higher than what we saw here in 2025. But that would be an average categorized by a majority of time likely where the rates are lower, and a minority of time where you see massive spikes in freight rates that over the year will more than compensate for the lower rates, because that would fit in the pattern we've also seen of disruptions with the pandemic, with the grounding of the Ever Given, with the Red Sea crisis. We have to acknowledge that the carriers over the last 5 years have really learned how to increase freight rates dramatically, even just for a few weeks when the opportunity arises.
Absolutely. And we actually see that when we model the companies and we look at their realized freight rates relative to some of the older index freight rates, they've typically been better because they've been actually able to manage that process either through some longer term contracts, but also in terms of what you say, being able to achieve those higher rates on certain voyages. So they've gotten a whole lot better at doing that. And that's great from an equity investor standpoint.
Smart call out that, week to week or even maybe month to month, you might see some larger changes, but then overall you'll have a lower freight rate throughout the years on an average.
But with that also, I mean, now is December 1st. We're entering the Christmas month. So obviously all Christmas goods have already been shipped a long, long time ago. Otherwise, you're not going to see them on the shelves. But in terms of seasonality, this is where we are now slowly beginning to hit the season of peak coming up from pre-Chinese New Year. Chinese New Year next year is mid-February. So we should expect the ramp up both in volumes, but potentially also in spot rates to become noticeable from the middle of this month.
Yeah, that's true. That'll be interesting to see how that compares, especially if demand starts to increase a bit.
Or in the case in the Pacific, demand starts to not decline as much.
Yeah, that's true. Well, I think if we see the tariffs kind of stay steady and there's not major news announcements, maybe people will feel a bit more comfortable starting to buy more, and then you'd see inventories go up. But obviously, that's more of a longer term.
That's more of a longer term. I think the thing to watch here is also what happens to actual holiday sales. How much a consumer is going to be resilient leading up to Christmas? Will they continue spending, or will they suddenly pull back because they feel the pinch? And it will also be interesting over the coming weeks to see a lot of the macroeconomic numbers come out of the various U.S. institutions that have been otherwise shut down during the U.S. government shutdown. I'm especially looking forward to seeing the inventory numbers when they get released.
Yeah, those will definitely be very interesting. And I think our listeners will be happy to know that we have some gifts. So the first one was today with Mark being on the podcast. We'll have a few more guests throughout the month of December. All right, everyone. Well, thank you so much for tuning in. We had a great episode today. I hope you all enjoyed it. I hope you have a really productive week.
Thank you.
Thanks for listening to Supply Chain Secrets Podcast, presented by NYFI. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.